Hello traders, Gary Wagner here just before 2 o'clock in Honolulu, 8 o'clock in New York. It is Friday. Happy Aloha Friday as we say on the islands. It is the 15th day of May, 2020, and this is the Daily Report for Gold and Silver, our weekend review, and what a week we have witnessed with this week gold taking off strongly to the upside as it begins to react to the contracting GDP that we have seen globally. There have been multitudes of economic reports that have confirmed the fact that our economies are shrinking, and that has to have a long-lasting effect even after the pandemic is over, because we're going to have to pay back a lot of money. $600 billion was fiscal stimulus and $3 trillion from the Federal Reserve. That will affect not only us, but our children and our children's children. We did put a trade on this week. We'll talk about that during our technical studies, but first, to the price board. Traders, now for the fifth day in a row, we have seen gold prices climb. Currently, we are at $1754.10. Up $13.20. We do have an active trade. We will discuss that when we pull up our technical studies. When we look at spot gained about 50 cents at $1741.50. Platinum had the largest percentage gain today, a gain of $47, currently fixed at $822.10. Palladium did well, but just about 4%, and it is at $1869.80. The dollar index was down fractionally. And lastly, silver. Silver gained 92 cents, a total of 5.72%, and closed today at $17.08. Traders, let's take a look at our technical studies. Traders, sometimes I do feel like the boy that cried wolf. I kept signaling that something was imminent, and yet for days it didn't unfold in the way I had predicted. And what I'm speaking about specifically is a compression triangle that we have been looking at. We simply created that from a series of lower highs and a series of higher lows. And for the most part, especially at the beginning of the week, and the week prior to that, what we were witness to was the fact that it attempted to break above it, this on two occasions right here, but even on this particular long green candle, you can see that it also traded to a low below the compression triangle. Then we had 2 days in which the lows kind of followed the compression triangle, but absolutely no breakout. That all changed 3 days ago when for the first time we actually saw gold trade above and close above, although slightly, this compression triangle. At this point, I didn't feel as though I was the boy that cried wolf. I saw the first signs, call it footprints, that we were going to break out and break out strongly to the upside. Because the theory behind a compression triangle is as you get a reduction of range, it builds energy. When it hits the apex of that triangle, the energy is released. Now, the market can break either to the upside or to the downside. However, during the vast majority of occasions in which you get a compression triangle, the breakout is to the most prevalent trend direction, which has certainly been up, and we can see that it followed suit on this occasion. When you consider that the market was trading at about 691 and closed at 1756, we have seen it have quite a week. And really, to illustrate the week, we're going to convert this daily compression triangle into a weekly compression triangle. When we look at a compression triangle through the eyes of a weekly chart, it becomes very evident the kind of contracting range we've seen. The low that begins it all is right here, and that low sits at approximately 1640. The following week, it had the record high of the year at 1788, and for the most part, what we have seen is a series of lower highs, and we have seen a series of higher lows. What is most impressive to me is the action this week, because It did open within the triangle, and during the week traded not only to it but really above it. This is truly a breakout to the upside. So the question that is on the majority of traders' minds is, now that it is broken out, where could gold go to in terms of higher pricing? While I think it's going to hit 1800, we do have two areas of resistance that it must overcome prior to doing that. The first one comes at about 1765. We can see that high, and we can see that today's high was just shy of that. But of course, the big number that we need to take out is the yearly high of 1788, because I believe any breakout above that price point inevitably will take all the short players and have them liquidate, which is in essence buying, and that should push us at least to 1800, if not beyond. This has been Gary Wagner, wishing you as always good trading. My recommendation is to maintain your current long position and to maintain your current stop.